So what if I told you that spending weeks, like really meticulously researching the best 50 technology stocks, analyzing their balance sheets and then carefully buying all of them on a single Tuesday afternoon makes you mathematically indistinguishable from a gambler just walking up to a roulette table and putting their entire net worth on red?
I mean, that is a jarring way to look at a portfolio.
Right.
But mathematically, structurally, it is the exact reality we're dealing with here. People so often confuse the feeling of being diversified with the actual mathematical reality of having a decentralized risk profile.
Yeah, they think spreading their money across 50 different logos on a brokered screen means they've built a fortress.
Exactly. When in reality, they've just built 50 different doors that all open up to the exact same tornado.
The exact same tornado. I love that visual. And that tornado, that hidden vulnerability that ties all those doors together, is exactly what we are going to untangle today. So welcome to today's deep dive.
It's a great topic today.
We have a really fascinating and honestly highly pragmatic mission ahead of us. We are looking at a source text that is short, incredibly dense, and highly actionable.
Very dense.
Yeah, it's a lesson simply titled Correlation, Same Investment, Different Days. And our singular goal for this session is to extract the exact step-by-step blueprint this text provides for building what it boldly calls an indestructible portfolio.
Right. Specifically in the realm of systemic trading. And calling a portfolio indestructible is, I mean, that's a massive claim to make anywhere, but especially in finance.
Oh, for sure.
It immediately grabs your attention because the market's primary function often seems to be destroying poorly built portfolios.
It's basically designed to find the weak spots.
Exactly. But what is really brilliant about this source material is that it doesn't just throw that word around for, marketing shock value. It actually attempts to mathematically and structurally justify how you engineer your way to that state of indestructibility.
But before we get into the engineering of it all, we really have to establish the ground rules. The text itself does this right out of the gate in the opening paragraph, so we need to echo it loudly for you listening.
Highly necessary disclaimer here.
Yeah. This deep dive is discussing an opinion based on experience. We are analyzing a theoretical blueprint presented in a source text. This is absolutely not financial advice.
Right. We are not telling you what to do with your own money.
Exactly, and you invest entirely at your own risk. Our job today is purely analytical. We are just here to unpack the mechanics of the philosophy presented in these pages, nothing more.
We are essentially mechanics today, just looking under the hood of a very specific engine design. We aren't telling you to go out and drive the car at 200 miles an hour on the highway.
Please don't do that.
Right. We're just explaining how the pistons are configured in this particular model to prevent the entire engine from just exploding under pressure.
Okay, so setting the stage for this engine design. The core premise of this text, the foundation upon which every other rule is built, is the idea that to survive long-term in the market, a mechanical trading strategy has to ruthlessly eliminate concentrated points of failure.
Ruthlessly.
And to do that, it introduces a concept that is going to be the absolute star of our show today, which is correlation.
Yeah, correlation. It's a term that gets tossed around in university statistics courses and institutional finance meetings all the time.
Oh, yeah, usually wrapped in incredibly dense, unreadable mathematical formulas.
Exactly. You usually see it represented by a Greek letter and a lot of complex calculus that just makes your eyes glaze over. But I really love how elegantly and brutally simple this text defines it.
Same.
It strips away all the academic jargon and states that correlation simply means things moving and failing together.
Things moving and failing together. It's almost poetic, but honestly terrifying if you are the one holding the things that are failing.
Very terrifying.
If you're trying to build something indestructible, the absolute last thing you want is for all of your structural supports to fail at the exact same moment.
Right. And the text outlines two primary types of this correlation that it argues must be completely, utterly eliminated if you want your capital to actually survive.
And notice it doesn't say mitigated.
No, it doesn't say mitigated. It doesn't say managed. It says eliminated.
Mm-hmm.
The first type is asset correlation, which we can kind of conceptualize as the what you are buying.
The what? Got it.
And the second type, which is much more insidious, rarely discussed, and honestly often completely ignored by even seasoned investors, is time correlation, the when you are buying.
The what and the when. It sounds deceptively simple on the surface, right? Just two variables.
Mm.
But as we are going to see, the implications of actually mastering those two variables are massive.
Truly massive.
Let's unpack this overarching philosophy first, though, because before we can dive into eliminating these specific risks of the what and the when, we really need to understand how the source text frames the ultimate goal of a trading system.
Yeah, context is everything here. The text doesn't start by saying, here's a trading strategy to generate triple-digit returns so you can buy a yacht.
Right, no get-rich-quick promises.
Exactly. It starts with a very specific, deliberately chosen opening phrase. It says, for a mechanical strategy to survive long-term. Let's just pause and isolate that one word. Mechanical.
That word really jumps off the page. It doesn't say a clever strategy or like an intuitive strategy based on your gut feeling. It specifically says mechanical.
And why does the author focus so intensely on a mechanical strategy? Well, the implication is a system that is strictly rules-based. It implies building a machine. And what do machines intrinsically lack?
Emotion.
They lack emotion. A mechanical strategy is designed to operate seamlessly, regardless of how the human operator is feeling on any given Tuesday morning.
Right.
It is completely devoid of the panic that makes an investor sell all their assets at the absolute bottom of a crash. And on the flip side, it is totally devoid of the euphoria that makes an investor leverage their account to buy at the absolute top of a bubble.
It just operates solely on a predetermined mathematical logic.
Exactly.
Which, when you look at behavioral finance, is incredibly hard for humans to do. We are deeply emotional creatures, and the financial markets are essentially just this giant global mirror reflecting collective human fear and greed.
It's a psychological battlefield out there.
It really is. When our own livelihood, our retirement, our savings are on the line, acting like a cold, unfeeling machine just feels completely unnatural.
It is arguably the hardest thing in the world to do when money is involved. And the second part of that opening thesis is equally important. It says the strategy must survive long-term. Notice what concepts are completely absent from that objective.
Yeah, there is no mention of profit at all. No mention of getting rich or beating the market or thriving.
Right. It doesn't prioritize thriving or maximizing profit right out of the gate. It prioritizes surviving.
Just staying alive.
In the world of systemic trading, survival is the absolute non-negotiable prerequisite for all future gains. The math of compounding interest, it only works if you're actually still in the game to let it compound.
That makes total sense.
If you suffer a catastrophic loss and you blow up your entire account in year one, it literally does not matter how brilliantly your strategy would have performed in year 2, year 3, or year 10. You weren't there to see it.
You've been wiped off the board.
Exactly.
Yeah.
The text treats the financial market as an inherently hostile environment where the default base rate outcome for an undisciplined participant is destruction. You have to actively engineer your way out of that default outcome.
Okay, let's unpack this engineering idea a bit, because the text specifically says you survive by eliminating, quote, concentrated points of failure.
Yes.
I keep visualizing this like we're engineering a massive physical structure. Let's say you are tasked with building a huge suspension bridge spanning a deep canyon.
Okay, I like this.
If you design it so that the entire weight of the structure, the steel, the concrete, the thousands of cars driving over it, the lateral force of the wind, if all of that dynamic load rests on a single central pillar, you have basically created a concentrated point of failure.
And that bridge is an absolute disaster waiting to happen, regardless of how strong that one single pillar looks on the blueprint.
Exactly. It doesn't matter how robust the steel cables are on the left side of the bridge or how beautifully paved the asphalt is on the right side. It doesn't even matter if that central pillar is made of the strongest titanium on Earth.
Right, because materials fail.
Exactly. If that one single pillar experiences a localized failure, like a microfracture or a foundational shift in the bedrock below it, or just some unexpected impact, the entire bridge crashes into the canyon.
The whole thing comes down.
The system was mechanically flawed from the blueprint phase because it allowed a single point of vulnerability to dictate the survival of the whole entity.
That is a phenomenal visual for what this text is warning against in the construction of financial portfolios. A concentrated point of failure means there is a hidden linchpin, right? A single structural dependency.
Linchpin, yeah.
And if that linchpin breaks, the entire portfolio is just wiped out. The text is demanding that we actively identify these pillars in our trading and systematically dismantle them, replacing them with a decentralized aggregate support system.
I really want you listening, just pause for a second and think about this in the context of your own life.
It's a great exercise.
Think about your own ventures. Whether we are talking about your current investment portfolio, a business you run, or even just a really complex project you manage at work. Are there hidden concentrated points of failure in your own systems?
Usually the answer is yes.
Right. Is there a scenario where the success of the entire enterprise relies on one specific individual performing perfectly, or one specific client renewing a contract, or one specific macroeconomic outcome going right? Because if there is, this text argues powerfully that it is not a matter of if that system will eventually fail, but simply a matter of when.
It is a deeply sobering audit to perform on yourself.
Mm.
And looking closely at those vulnerabilities perfectly transitions us into the first massive trap the text identifies in the financial markets.
Let's get into it.
We have defined the overarching goal, which is eliminating these concentrated points of failure. So now we have to look at the first faulty pillar that people mistakenly build their portfolios upon. The text categorizes this as asset correlation.
Asset correlation. Okay, so this is the what that we mentioned earlier.
What exactly? Asset correlation is defined in the source material as the risk of holding investments that react identically to the same negative events.
Meaning they all go down together.
Right. When the economic environment turns hostile, do all your investments suffer from the exact same structural vulnerability? Do they all catch the exact same cold?
And the text specifically calls out a very common, almost universally encouraged behavior here. It points the finger directly at what we might just call the retail trap.
The retail trap. Yeah.
It says that when retail investors, meaning everyday people, trading their own brokerage accounts from their laptops or their phones, when they buy individual stocks, they're walking straight into this trap with their eyes wide open.
The text really pulls no punches here. It states unequivocally that by choosing to buy individual stocks, the investor, quote, accepts massive single company risk.
Accepts. That is a very deliberate choice of verb right there. It implies a transaction.
It does. It implies a structural bargain that perhaps the retail investor doesn't even fully realize they are making.
Right. They just think they're buying a good company.
Exactly. When you hit the buy button on a share of company X, you are tethering a portion of your net worth to the specific fate, the specific operational competence of that singular corporate entity.
And companies fail all the time.
All the time. The text gives some brutal, real-world examples of how this fails. What if the CEO is suddenly fired for an accounting scandal over the weekend?
Oh, man. Yeah.
Or what if their highly anticipated quarterly earnings report completely misses Wall Street's expectations due to some supply chain failure that literally no one saw coming?
The stock price just craters. Instantly.
It craters, and here is the really crucial part that people miss. That cratering has absolutely nothing to do with the broader economy.
That's a great point.
The global economy could be booming, right? Interest rates could be perfectly low. Consumer spending could be at all-time highs. But because you tied your money to that one specific pillar, and that pillar rotted from the inside out due to poor management or just bad luck, your money goes down with it.
It's totally isolated to that one bad decision.
Exactly. That is the essence of single company risk. It is an unforced error. It's a massive, concentrated point of failure that you actively volunteered to take on.
Okay, I am going to push back on this a little bit, just playing devil's advocate based on the standard financial advice we basically all hear growing up.
Sure, let's hear it.
What if the listener knows not to just buy one stock? What if they say, I understand single company risk. I'm not going to put all my retirement money into one single hardware manufacturer. I'm going to build a diversified portfolio.
The classic diversification play.
Right. They say, I'll buy 50 different technology stocks. I'll buy the hardware manufacturers, the software developers, the cybersecurity firms, the cloud infrastructure companies. Doesn't that level of diversification protect them from that one rogue CEO getting fired?
It is the exact logical leap most intelligent people make when trying to solve this problem. They understand the danger of one company, so they buy 50. But the text explicitly and mathematically shuts this down. It argues that no, buying 50 tech stocks does not protect you from the true systemic danger of asset correlation.
Because if we follow the logic laid out in the text, those 50 companies are still highly correlated to each other.
Precisely. If you buy 50 different tech stocks, you haven't actually eliminated your concentrated point of failure. You've just shifted the dependency slightly higher up the chain.
Okay, I see what you mean. It is like, imagine a shipping company buying 50 different cargo boats because they are terrified about one specific boat springing a leak and sinking.
That's a great analogy.
It seems really smart at first, but then They decide to tie all 50 of those boats to the exact same heavy iron anchor in a really shallow harbor.
Oh, wow. Yeah.
So if a massive hurricane hits, or if the tide suddenly drops, that anchor drags. And it drags every single one of those 50 boats to the bottom of the ocean at the exact same time. It doesn't matter that they were structurally different boats, painted different colors, with different captains steering them.
None of that matters.
Right. They were all highly correlated to the exact same environmental anchor. So if the technology sector as a whole experiences a macroeconomic downturn, let's say, I don't know, the Federal Reserve unexpectedly spikes interest rates, which historically just crushes the valuations of high-growth tech companies.
Yep, it absolutely does.
Or perhaps some sudden, sweeping piece of international legislation cracks down on data privacy across the whole industry. That anchor drops. Every single one of those 50 tech stocks is going to plummet simultaneously.
The boat and anchor analogy captures the mechanics perfectly. If the broader tech sector drops, the tech states flatly, your entire portfolio drops together. You haven't decoupled your risk at all.
You just disguised it.
Exactly, you disguised it. You have just created a highly localized cluster of failure. You took 50 single company risks and bundled them into one massive sector risk. This is why the psychological allure of the retail trap is so dangerous and honestly so difficult to break away from.
But why do we do it, though? Like, if the math clearly shows that stock picking or sector clustering is just inviting concentrated failure, why is it arguably the most popular way retail investors interact with the market?
Because picking individual stocks provides this really powerful illusion of agency.
Oh, that makes sense.
It feels productive. It feels like you are doing deep research, finding the hidden gem, outsmarting the institutional money. It totally feeds the human ego.
We all want to be the genius who bought the next big thing early.
Exactly. We all want to believe we have the analytical prowess to pick the winning horse before the race even starts. But this text is arguing that systemic trading, specifically mechanical trading, doesn't care about your ego.
The market certainly doesn't care.
It doesn't care about your elaborate narrative regarding a company's new product launch. It only cares about mathematical survival. And mathematically holding individual stocks or clustered sectors is just voluntarily inviting a single point of failure to wipe you out.
It's an unforced error.
It is. You are taking on a severe, concentrated risk that you absolutely fundamentally do not need to take to participate in the market's growth.
Okay, so if picking individual stocks is tying our bridge to a faulty pillar, and picking a single sector is tying all our boats to the same anchor, how does the source text propose we actually fix the what? Because we are still trading the stock market, right? We have to put our capital into something.
You do. And the text provides a very specific structural solution to fix this asset correlation problem. It proposes what we can refer to as the aggregate solution.
The aggregate solution. I like the sound of that.
The text argues that the only viable solution to single company risk is trading a highly diversified broad market index. It specifically points to the S&P 500, which, as you know, is the index tracking the performance of the 500 largest publicly traded companies in the United States.
Right.
And the text even gets quite granular, mentioning specific instruments a systemic trader might use to do this, like forward/ES futures contracts.
Yeah, I am looking at the text right now, and it does explicitly mention those /ES futures. For the listener who might just be used to buying a standard ETF, like, say, the SPY in their retirement account, why does a systemic trading text point toward futures contracts? What is the mechanical difference there?
It really comes down to capital efficiency and the structural mechanics of how systemic traders actually operate.
Yeah.
So forward/ES is simply the ticker symbol for the E-mini S&P 500 futures contract.
Okay.
When you buy a standard ETF like SPY, you generally have to put up the full cash value of the shares you are buying. If you want $100,000 of exposure to the S&P 500, you need $100,000 in cash sitting in your account.
Dollar for dollar.
Exactly. But futures contracts are derivatives that use leverage. They're essentially a legal agreement to buy or sell the value of the index at a future date. And because of this structure, exchanges only require you to post a fraction of the contract's total value as collateral.
What is what we call margin?
Yes.
So a trader might only need to put up, say, $10,000 or $15,000 in margin to actually control $100,000 worth of S&P 500 exposure.
Precisely. And that is vital for the second half of this text strategy, which we will definitely get to, because it allows the trader to have broad market exposure while keeping a massive amount of their actual capital sitting safely in cash reserves.
Oh, I see where this is going.
Right. But regardless of whether a trader uses /ES futures or options on those futures or just standard broad market ETFs, the underlying conceptual mechanism is exactly the same. You're trading the index itself, not the individual components.
Okay, let's break down exactly how trading that index actually solves the correlation problem. How does buying the S&P 500 fix the broken pillar on our bridge?
Let's zero in on the exact phrasing the text uses here, because the distinction it makes is honestly brilliant. It says that by trading the S&P 500, you are no longer betting on a single company. You are betting on the aggregate strength of the top 500 companies in the U.S. economy.
The aggregate strength.
It is a complete paradigm shift
Oh,
in
yeah.
how you view your capital. You are no longer asking the fragile question, will company X's new smartphone succeed next quarter?
Right, which is impossible to know for sure.
Exactly. Instead, you are asking a much more robust, structural question. Will the collective aggregate economic engine of the 500 largest, most highly capitalized companies in the United States continue to generate value over the long term?
This goes right back to that concept of decoupling. By trading the aggregate index, my money is completely mathematically untethered from the fate of that one scandalous CEO we talked about earlier.
Completely untethered. To really understand why, we have to look at the mechanics of how the S&P 500 actually functions behind the scenes. It is not just a static, unchanging list of 500 companies.
It's not just a club you get into and stay forever?
Right. It is a market capitalization weighted index. That means the larger a company's total market value, the larger percentage of the index it makes up. But crucially, it is a dynamic self-cleansing mechanism.
Self-cleansing. Okay, explain how that works in practice. I think that's a key concept.
Let's look at some historical examples. Think back to a company like Enron in the early 2000s, or Lehman Brothers back in 2008.
Oh yeah, massive implosions.
These were massive, Titan-level corporations that were heavily weighted in the major indexes. When those companies began to fail, when the fraud was exposed at Enron or the balance sheet totally collapsed at Lehman, their stock prices plummeted.
Obviously.
Right, and as their stock price plummeted, their market capitalization shrank. Because the S&P 500 is cap-weighted, as those companies shrank, their mathematical influence on the index automatically shrank right along with them.
So the index naturally reduces its exposure to failing companies without the trader having to manually do anything.
Exactly, and it goes even further than that. Eventually, if a company falls far enough, it no longer qualifies to be in the top 500. The index literally boots them out.
Just kicks them to the curb.
It kicks the failing company to the curb and replaces it with a new, stronger, growing company that has climbed the ranks. The S&P 500 is essentially an automated, ruthless momentum strategy disguised as a passive index. It constantly sells the losers as they shrink and buys the winners as they grow.
So the aggregate structure actually absorbs the blow of individual corporate failures.
Yes. That is the mechanical magic of the aggregate solution. If one massive company in the S&P 500 goes completely bankrupt tomorrow and its stock goes to absolute zero, it is an absolute tragedy for that company's employees, right?
A ripple.
And a total financial wipeout for the retail investors who held that single stock. But for the systemic trader holding the S&P 500 index, it is barely a blip on the radar. The other 499 companies are there to absorb the blow.
The load is redistributed.
Precisely. The loss of that one company is mathematically diluted across the aggregate to the point of near irrelevance. You have structurally decoupled your capital from individual corporate failure.
Eliminating asset correlation, as the text concludes this section, protects you from bad companies. You literally do not have to spend a single ounce of mental energy caring if a specific company's earnings report is bad tomorrow because your portfolio is not exposed to them in isolation.
That's a huge psychological relief, too.
It really is. You have engineered a bridge supported by 500 distinct pillars. If one pillar crumbles into the canyon, the bridge doesn't even sway. The dynamic load is instantly redistributed to the other 499.
You have successfully solved the what? You have engineered a portfolio where the underlying asset is highly resistant to single points of failure. Now, here is the problem.
There's always a catch.
Most investors, even institutional ones, stop right there.
Yeah.
They buy their broad market index fund, they look at their dashboard, and they think, I'm diversified, I'm safe, I have built the indestructible portfolio.
But the text is basically saying, congratulations, you fixed half the problem. Now brace yourself for the other half, the half you probably didn't even know existed.
The massive, unseen curveball.
The text throws this massive conceptual curveball at us. It states that diversifying what you buy is entirely useless if you do not diversify when you buy it.
Time correlation.
Time correlation, the blind spot, the trap of the, quote, single Tuesday afternoon. When I first read this section of the source text, I had to stop and reread it like 3 times because it perfectly describes a mistake almost every single investor has made at some point.
Oh, absolutely.
Mm.
Let's paint a really detailed picture of this Tuesday afternoon trap because it is the most common catastrophic error in portfolio construction. And it is almost entirely driven by human impatience and the desire for psychological comfort.
Let's set up the scenario. Let's say you have a lump sum of cash. Maybe it is an inheritance, maybe it's a massive bonus from work, or maybe it's just cash you've been aggressively saving for years and you finally feel ready to deploy it into the market.
A very common scenario.
Right. You have read the first half of this source text, so you are feeling very smart. You know not to buy a single stock. You know the S&P 500 is the aggregate solution. So it is 2 p.m. on a random Tuesday afternoon. You log into your brokerage platform, you pull up the S&P 500 index, you take your entire cash balance, 100% of your available capital, and you hit the buy button all at once.
In that moment, the psychological feedback loop is entirely positive. You feel great. You are officially an investor. You are diversified across 500 of the greatest companies on Earth. You feel totally safe.
But the text is essentially screaming at us that this trader just committed a fatal error.
A potentially portfolio-ending error.
Let me use an analogy here, because the bridge and the boats covered the what, but we really need a mechanism to understand the when.
Let's hear.
Deploying all your capital on a single Tuesday afternoon is like a farmer who has to feed his family for the entire year. He looks outside on the very first warm day of spring, sees the sun shining, and decides to plant 100% of his seeds in the dirt at the exact same moment.
That is a much more precise way to look at the mechanics of time correlation. The farmer sees that the conditions on that specific Tuesday look perfect. The soil is warm, the sky is clear, so they take their entire year's livelihood, every single seed they own, and commit it to the environment simultaneously.
And the glaring, obvious flaw in that strategy is the weather.
The unpredictable weather.
Right. If an unexpected late-season frost hits on Wednesday night, the entire crop is wiped out. The farmer solved they bought the highest quality, most resilient seeds available, but their when was concentrated into a single massive point of failure. They didn't diversify their exposure to the weather.
That is exactly what happens in the financial markets. The text demands that we deeply analyze the 3 converging risks that this Tuesday afternoon trader has just exposed themselves to. Because the text breaks down exactly why planting all those seeds at once is so dangerous in a market environment.
It's not just one risk, it's a convergence.
Exactly. It identifies 3 specific metrics that are now highly perfectly correlated in your portfolio.
I am looking at the text here, and the first risk it lists is a uniform entry price, which, makes logical sense. Because the trader deployed all their capital at 2 p.m. on Tuesday, every single dollar they own is tethered to the exact price the market was trading at during that specific minute.
Exactly. If the market happened to be at an all-time historic high that Tuesday afternoon, 100% of your capital is now locked in at the absolute peak. You have no ability to average your costs down if the market drops on Wednesday.
You're just stuck there.
Right. Your entire portfolio's profitability is entirely dependent on the market moving higher from that one specific isolated price point.
Okay, the second risk the text outlines is uniform volatility exposure. This one definitely requires some unpacking. How does volatility act as a concentrated point of failure?
This is a really crucial concept in systemic trading, especially if you're using derivatives like those /ES futures or options that the text mentioned earlier.
Right, because options price in volatility.
Exactly. Volatility, which is often tracked by indices like the VIX, is essentially the market's expectation of future turbulence. Think of it like the price of insurance. When the market is calm and complacent-like on a sunny Tuesday afternoon, insurance is cheap, implied volatility is low.
Makes sense.
But when a storm is coming, people panic, and the price of that insurance skyrockets. Implied volatility expands rapidly.
So how does this actually hurt our Tuesday trader?
Well, if you deploy 100% of your capital on a calm Tuesday afternoon, you are buying into a low volatility environment. You are purchasing your assets or writing your contracts at prices calibrated for a calm sea.
Okay.
But what happens if a surprise macroeconomic storm hits on Wednesday? The implied volatility of the entire market will explode upward. If you're trading derivatives, that sudden expansion in volatility can absolutely crush the pricing of your positions, even if the actual S&P 500 index only drops a few percentage points.
Wow, just the expectation of a drop hurts you.
Exactly. And because you deployed everything at the exact same time, your entire portfolio have identical uniform exposure to that specific volatility shift.
Yeah,
You bought the calm, and you got wiped out by the repricing of the storm.
that makes perfect sense. You didn't just buy a price, you bought a specific environmental condition.
Well said.
And the third risk the text lists is a uniform expiration date. This brings us back to those /ES futures we discussed. We aren't just buying a passive ETF that sits there forever. We are trading instruments that are on a ticking clock.
Right. Futures contracts and options contracts have finite lifespans. They expire. For S&P 500 futures, they generally expire quarterly March, June, September, December.
Okay.
If you deploy all your capital into contracts on that single Tuesday afternoon, every single one of your positions is going to expire or require rolling over into the next contract on the exact same day.
So we have the exact same entry price, the exact same volatility exposure, and the exact same ticking clock. Why is this convergence such a massive point of failure? I mean, what's the spark that blows this up?
Because of the catalyst the text introduces next, which is the unexpected market shock. What happens if a sudden, massive geopolitical conflict erupts overnight on Wednesday, or a major central bank announces a completely unexpected, aggressive interest rate hike on Thursday morning?
The late season frost hits the crops.
The frost hits, and because of your Tuesday afternoon deployment, the text makes the mathematical reality chillingly clear. It says 100% of your capital is caught in the exact same freeze simultaneously.
Nowhere to hide?
Nowhere. Every single dollar takes the maximum possible hit from that specific news event. Because you did not diversify your time, your entire net worth is now perfectly one-to-one correlated to the bad luck of Wednesday morning's news cycle.
I really want you to perform an audit on your own thinking here. Think about the concept of unexpected market shocks. Look closely at the phrasing in the text. It doesn't ask if these shocks will happen. The implicit foundational understanding in any mechanical trading strategy is that these shocks will happen.
They are a guarantee.
They are not anomalies. They are a baked-in feature of the global financial system. The Black Monday crash in 1987 was a shock. The 2010 flash crash, where the market dropped nearly 1,000 points in minutes, was a shock. The onset of the global pandemic was a massive shock.
They are inevitable, recurring features of complex systems.
They are inevitable. So the question you have to ask yourself is, how is your own time exposure managed right now? If a massive unexpected shock hits the market tomorrow morning at 9:30 a.m. when the opening bell rings, is 100% of your capital going to take the full, unfiltered, maximum impact of that specific moment in time?
It's a scary question to answer, honestly.
Because if the answer is yes, you have not actually eliminated your concentrated points of failure. You have simply moved the failure point from the individual company level over to the calendar level.
That is a profound structural realization.
Yeah.
You successfully survive the CEO risk, you survive the earnings report risk, only to get completely wiped out by the calendar risk. The Tuesday afternoon trap is a perfect storm of vulnerability, is the ultimate concentrated point of failure.
Okay, so this paints an incredibly bleak picture. If we cannot predict these unexpected market storms, and no one can, right? No one has a crystal ball for geopolitics or flash crashes.
Prediction is a complete fool's errand in systemic trading.
I agree completely.
The market is too complex, with too many variables, to ever predict short-term shocks with any reliable accuracy.
So if we absolutely cannot predict the storm, we have no choice but to structurally defend against it. We need a mechanical defense mechanism. And thankfully, the source text actually offers one. It provides a very specific, mathematically sound solution to time correlation.
Yes, it does. And it calls this mechanical solution establishing a daily speed limit.
A daily speed limit. I just love the psychology embedded in that phrasing.
It's very visual.
It immediately implies that the natural human urge is to drive too fast, right? To deploy everything at once to get the dopamine hit of being fully invested, and the mechanical system must actively force you to slow down.
You have to fight your own instincts.
So let's unpack the mechanics of this daily speed limit. The text states this means strictly limiting your deployment to a measured percentage of your total portfolio each day. How does this actually work in practice? How does staggering your entries mathematically change the profile of a potential portfolio blowout?
Let's walk through the methodology step by step, contrasting it with our previous example. Let's go back to our hypothetical trader with their lump sum of cash. Instead of falling into the Tuesday afternoon trap and deploying 100%, They are now operating under the text's mechanical rule.
Okay, they have the rule book now.
Let's say their system dictates a daily speed limit of exactly 5%. They are only allowed to deploy 5% of their total available capital into new positions on any given trading day.
Okay, 5% is the hard limit, the governor on the engine.
Right. So on Monday, the market opens and they deploy 5%. On Tuesday, they deploy another 5%. On Wednesday, another 5%. They are actively mechanically forcing their capital to spread out across time.
They are diversifying the when.
Exactly. Now let's look at the structural advantage this creates, which the text emphasizes heavily. By enforcing this 5% limit, your active trades will always have different entry prices.
Because the market is a dynamic auction. It moves every single day.
Right.
The price of the S&P 500 on Monday at noon is going to be mathematically different from the price on Thursday morning.
Exactly. You are no longer locked into one single vulnerable price point at the top of a potential peak. You are averaging your entry prices over days, weeks, and months. You are smoothing out the curve.
That makes a lot of sense.
Furthermore, to go back to the derivatives risk we talked about, your positions will now have different volatility exposures. You are buying some contracts when it's calm and some when it's turbulent. And crucially, if you are trading futures or options, they will eventually roll over into different expiration cycles.
We have essentially decoupled our money from the risk of a single bad moment in time. To go back to the farming analogy, we aren't planting all our seeds on Tuesday. We are planting 5% on Monday, 5% on Tuesday, 5% on Wednesday.
You have fully decentralized your time risk. You took that massive monolithic pillar of time, that single Tuesday afternoon, and you mechanically broke it down into dozens of smaller, completely independent pillars.
Now, I have a mechanical question here, playing the role of the listener trying to build this system.
Sure. Yep.
If I am deploying 5% of my capital every single day, Monday, Tuesday, Wednesday, by the end of 4 weeks, mathematically, I have deployed 100% of my money. I am fully invested and I have no cash left. Doesn't that just mean I delayed the Tuesday afternoon trap by a month? How does this speed limit actually maintain its defensive posture long term?
That is an incredibly astute observation, and it addresses the core difference between simply buying and holding an ETF versus running a dynamic systemic trading portfolio.
Ah, okay.
The text implies a mechanical strategy that manages active positions. This means trades have a life cycle. They don't just stay open forever.
They breathe in and out.
Exactly. A mechanical system will have predefined exit rules. While you're deploying 5% into new positions today, some of the positions you opened 2 weeks ago might be hitting their profit targets and mechanically closing out. Other positions you opened a month ago might be hitting their stop-loss limits and closing out.
Ah, I see. So capital is constantly returning to the cash pool.
Precisely. It is a continuous loop of capital recycling. It is a conveyor belt, not a bucket that you just fill up until it overflows.
I love the conveyor belt visual.
As old trades resolve, they dump their capital plus profits or minus losses back into your cash reserve. By maintaining a strict daily speed limit on the entry side and allowing trades to naturally close on the exit side, a properly calibrated mechanical system ensures that you almost never reach a state of being 100% fully invested.
You're always holding something back.
You mathematically enforce a state where a significant portion of your portfolio is always sitting in a protected cash reserve.
That structural cash reserve is the key. To fully understand the power of this system, I think we need to stress test it against the absolute worst case scenario.
Let's do it.
We need to use the text's own logic and throw a massive, unexpected market shock at it.
Let's bring on the crash. Let's simulate a disaster.
Okay, so our systemic trader is diligently following their speed limit. They deploy their allotted 5% on a Monday afternoon. And let's say Monday night, after the market closes, the absolute worst happens.
The black swan event.
A catastrophic global event occurs. The financial system panics overnight. When the opening bell rings on Tuesday morning, the market drops through the floor. It is a historic, violent crash. My Monday trade, that 5% I just deployed, it is toast. The derivatives are crushed, the index is plummeting. That 5% is completely underwater.
Yes. We have to be intellectually honest here. That 5% position is ruined. A mechanical strategy does not possess a magic shield that prevents losses from happening. The market goes down, your open positions go down.
Right. But the distinction is in the magnitude of the destruction. Instead of a total portfolio wipeout, what exactly happens next, according to this system?
I want to highlight the exact, specific word the text uses here, because it's the pivot point of the entire strategy. The text states, If a market shock hits and destroys Monday's trade, it is an isolated event.
Isolated.
Isolated. Think about how incredibly powerful that word is in the context of a global market panic. Usually a market crash is a systemic contagion. It ruins everything it touches.
Right, everyone is screaming.
But in this engineered portfolio, the damage is strictly contained. The frost hit the farm, but it only killed the 5% of seeds you planted on Monday. The other 95% of your seeds are sitting perfectly safe in the barn.
The Monday pillar fell into the canyon.
The Monday pillar was obliterated. But what about the capital you had designated to deploy on Tuesday or Wednesday, or the capital waiting to be deployed next month?
It is still sitting in cash. It wasn't in the market when the shock hit.
Exactly. The text clearly states that the capital deployed on Tuesday or Wednesday remains insulated, and the cash held in reserve is perfectly protected. You did not lose 100% of your portfolio because the vast majority of your portfolio wasn't even exposed to the environment when the storm hit.
That's incredible.
You engineered a system that structurally isolates the damage of unexpected shocks.
Okay, but it gets better than just surviving the damage, right? The source text doesn't just pat you on the back and say, good job, your cash is protected. It points out a massive, aggressive advantage to having that specific cash available at that specific time.
This is where the strategy brilliantly shifts from playing pure defense to executing a structural offense. The text says that this protected reserve cash is now ready to capitalize on the new market pricing.
The new market pricing, which after a crash means a massive discount.
Exactly. Let's go back to that chaotic Tuesday morning after the overnight crash. The market is bleeding. The financial news networks are panicking. Everyone who fell into the Tuesday afternoon trap the week before, the people who deployed 100% of their capital at the top, they are trapped in a total nightmare.
They're completely stuck.
They're taking maximum portfolio-destroying losses, and crucially, they have zero cash left to buy the dip. They are completely paralyzed.
But our mechanical trader, the one who actually obeyed the speed limit.
Our mechanical trader wakes up on that exact same Tuesday morning. Yes, they look at their screen and see that their 5% position from Monday is hurting, but then they look at their total account balance and they see a massive pile of dry powder sitting in cash.
It's all just sitting there waiting.
And what is the market offering them on this panic-stricken Tuesday morning?
A historic fire sale. Everything is marked down.
Exactly. Because they enforce the daily speed limit, the trader has the capital required to act. The system doesn't just survive the bad day, it is structurally, mathematically positioned to aggressively buy into the newly discounted market.
They become the buyer of last resort.
When their mechanical rules tell them to deploy their Tuesday 5% allocation, they are buying assets or writing contracts at prices that are drastically lower and drastically more advantageous than the prices they paid on Monday.
They're literally buying the blood in the streets, but they are doing it mechanically, safely, and entirely without emotional panic because their system was meticulously designed to have cash ready for exactly this catastrophic moment.
It completely flips the psychology of a market crash on its head. For a fully invested, time-correlated trader, a sudden crash is the end of the world. It is game over.
Yeah, time to panic.
But for a systemic trader utilizing a strict daily speed limit, a crash is merely an isolated minor flesh wound on a small percentage of their capital, immediately followed by a massive, asymmetric opportunity to acquire assets at a steep discount.
That is incredible. It really just fundamentally rewrites how you view and interact with risk. It transforms risk from something you fear into something you mechanically manage and even exploit. Let's reiterate the text's powerful concluding mantra for you listening, because it perfectly, succinctly synthesizes everything we have spent this session unpacking.
The text ends with these two sentences, and honestly, they are absolutely worth writing down and taping to your monitor. It says, eliminating asset correlation protects you from bad companies. Eliminating time correlation protects you from bad days.
Eliminating asset correlation protects you from bad companies. Eliminating time correlation protects you from bad days. It is so clean.
Very clean.
It is so logical. It is exactly the blueprint we were looking for when we started this whole process. We opened this deep dive looking at a short, dense text, trying to find the mechanics of building an indestructible portfolio, and I think we unpacked exactly what that mechanical engineering looks like.
We have. We've journeyed from understanding the basic abstract concept of correlation things failing together to implementing a very specific two-pronged mechanical defense system.
First, we defend against the what by executing the aggregate solution. We stop feeding our ego by trying to pick winning individual stocks. And instead, we harness the mathematically self-cleansing aggregate strength of the S&P 500, completely decoupling our capital from individual corporate failures.
And second, we defend against the when by establishing a strict daily speed limit. We flatly refuse to put all our capital at the mercy of a single, unpredictable moment in time.
No more Tuesday afternoon traps.
We force our money to spread out across days and weeks, isolating the damage when the inevitable market shocks occur, and ensuring we always have a protected cash reserve ready to aggressively capitalize on new, discounted opportunities.
It is a phenomenal, mathematically elegant system. It makes so much structural sense. But as we wrap up this deep dive, I know you have a final thought you want to leave the listener with, something that builds directly on this source material, but really challenges how easy it is to actually pull this off when the real money is on the line.
Yes, I do. I want to leave you with a final provocative thought to mull over as you analyze your own systems. We have just spent this entire session praising the absolute mathematical perfection of this text's blueprint.
It is a great blueprint.
The math works. It's undeniable. Cap your daily deployment, hold cash in reserve, trade the aggregate index. On paper, it is indeed an indestructible portfolio.
On paper.
On paper, in a spreadsheet. But remember, the very first critical requirement the text laid out in its opening sentence, it said, for a mechanical strategy to survive long-term.
Mechanical.
The text assumes perfect, flawlessly emotionless execution of the rules. It assumes you are a machine executing code. But you are not a machine. You are human.
And humans are messy, emotional creatures, especially when our net worth is fluctuating on a glowing screen in front of us.
We have incredibly strong primal emotions when it comes to financial security and status. And human nature absolutely hates, passionately despises, sitting on uninvested cash when the markets are roaring.
Oh, it's the worst feeling.
Imagine a scenario where there is no crash. Imagine the market is in a massive euphoric bull run, going up 1 or 2% every single day for a solid month. Your friends are making a fortune on speculative tech stock.
Everyone is bragging online.
Everyone on your social media feed is showing off their massive leveraged gains. And there you are, quietly obeying your daily speed limit, only deploying your 5% while a massive chunk of your money sits in cash, earning a fraction of a percent, seemingly missing out on the greatest rally of the decade.
The fear of missing out. FOMO. It is arguably the most powerful psychological drug in the financial markets.
It is the ultimate enemy of the mechanical strategy. The urge to break your own rules, to take that carefully protected cash reserve and dump it all into the market on a soaring Tuesday afternoon, just to catch up to your peers. That temptation becomes overwhelmingly loud.
You just want to take the governor off the engine. You want to plant all the seeds because the sun looks so incredibly warm.
Exactly. You want to abandon the blueprint. So the ultimate question for you to deeply explore, the question this source text ultimately forces you to ask yourself in the mirror, is this. Can a purely mechanical strategy survive the emotional urges of the human trader trying to execute it?
That's the real test.
You can fix the asset correlation. You can mathematically map out the time correlation. But the greatest concentrated point of failure might not be the asset you choose, and it might not be the time you choose to buy it.
Wow.
The final pillar, the one that is most likely to snap under pressure, might just be your own discipline. Do you possess the psychological fortitude required to actually obey your own speed limit when everyone around you is driving 100 miles an hour?
Are you the weak, concentrated pillar in your own indestructible bridge? That is a fascinating and, honestly, somewhat haunting thought to leave on. It all comes back to that engineering metaphor. You can design the absolutely perfect bridge on a blueprint, but if the material you use to build it, in this case your own human psychology and discipline, is fundamentally flawed, the bridge will eventually fall into the canyon. Thank you for joining us on this deep dive. Until next time, audit your systems, watch your speed limits, and keep a very close eye on your pillars.